Hello, friends. So looks like the war between United States and Iran is almost over. And I say almost because you never want to say it's over until it is over. Wars are very unpredictable in nature. They can, kind of turn around at any moment. Somebody can make a mistake and that can take a different shape. So I would be very, very cautious if you are 100% in a camp that war is over. It's not over until it is over. Having that said, I think we have a lot of positive signals, both from the United States and the Iran. So we're certainly getting there. And as far as market is concerned, and there's no, okay, we are done with it. Market is up pretty much the whole week. Most of you guys have probably recovered everything that you might have lost during the war. And now you're feeling, okay, this is the beginning of the year and we start building wealth again. I want to talk to you today about not the war, but rather about earnings, especially the banks. Banks has given out some wonderful earnings. I think it's important that we understand those because when banks give earning, it has implications on everything in our life. It's important for us to understand that. So I want to share that data with you guys so you're better prepared as to what is about to come in the economy. But before I go there, let me remind you guys that it is very hard to predict the markets and it's very hard to time the market. So I see again and again every single year a lot of people lose money because they are timing against the market or they're timing that market is going to continue to go up. And both the time, it's always a mistake. Sometimes people get lucky and for 1 year, they might make a whole lot of money and then next year they might lose out. So it's just so much easier if you don't make those kind of bets and just kind of stay grounded and let the wealth grow slowly. I think it works out in your favor. You have less anxiety. You can sleep. Like, for example, when market was down, honestly speaking, I didn't even open my brokerage account. I was just chill. When I saw some good opportunity to buy something, I made some minor purchases and that's about it. We all are constrained by cash flow as to what we can buy. So that was the only decision I had to make. I didn't have to worry about anything else and rest was automatically taken care of. So just a friendly reminder, if you're struggling in market. Now, those of you guys who don't know me, I'm not an investment advisor. I don't tell you what to buy, what to sell, when to buy. Those are none of my business. I'm a tax advisor. So if you need help with your taxes, or you're working with a tax professional who never calls you, who cannot get on Zoom with you, who cannot give you his time to make sure you're well taken care of, you're paying a lot of money in taxes. Even though if you think your taxes are simple, you just have a W-2 income and you still end up paying a lot of taxes, it's a good idea to work with a tax professional who works with you directly. Like he doesn't really outsource you to somebody else. And and that's it. Like he sees you once a year. So if you want to make that kind of change, then I'm your guy. You can reach out to me via taxcodeadvisors.com. If you want to learn about finance, then I have a coaching program. You can join that and learn about this finance mystery because you don't really learn finance like in 1 day or 1 week or 1 month or even 1 year. It takes years because you're developing this mental stamina to deal with these ups and downs. And once you do it, you start to make money. Okay, enough about that. Let's talk about earnings. One of the favorite companies is Goldman Sachs. As you guys know, Goldman Sachs is an advisor to a lot of people, especially ultra wealthy people. I look at their earnings, it was beautiful. I mean, $5.3 billion revenue just from trading alone. Total profit was 5.63 billion. That is up 20%. Well, not 20, I think almost 19% from last year. So very great earnings. Their stock trading revenue hit all-time record, up 27%. Fees earned on advising on company merger and acquisition surged 48%. I talked about that last year, that I expect a lot of merger and acquisitions going on this year. So they certainly are the big beneficiaries of those. Companies paid Goldman for guidance and navigating this volatile market. So they made some revenue out of that. They ranked number one globally in mergers deal making this quarter. The firm now manages $3.1 trillion in client wealth, growing for 29 straight quarters. I mean, this is a great compounder. A dividend raised to, I think, $4 share and a $5 billion stock buyback, signaling that company still thinks that stock is undervalued. So overall, wonderful earnings. Now, what to watch out for in Goldman Sachs? Well, Goldman earns most of its money from trading and deals fees, obviously, not from everyday banking like mortgages and loans. So when markets calm down and fewer deals happen, earnings can swing dramatically. CEO David Solomon warned that environment entering Q2 is marked differently, a cautious signal. Goldman has no buffer of ordinary lending income if investment banking activity slows. You have to keep an eye out on it. Now, Goldman's 48% jump in merger and acquisition fees far outpaced JP Morgan Chase, which was at 28%, Bank of America, which was at 21%, and Citigroup at 12%. In pure deal making prestige, Goldman Sachs remains the gold standard, but JP Morgan total revenue of $50.5 billion is nearly 3 times larger because it also have a massive consumer banking business. Goldman simply doesn't have that. So that is what you want to know about Goldman. If we get interest rate cuts, by the way, you can just imagine what will happen to Goldman Sachs. So I hope this kind of clarifies you where the opportunities. And now, just to be transparent, I do own Goldman since a couple of years, and it has been wonderful for me. Next one on my list is JP Morgan Chase. We can't miss JP Morgan Chase. This is America's largest bank by total assets of $4.4 trillion. It serves everyday consumers, small businesses, corporations, and government worldwide. So if you own any kind of business in the United States, most likely you are doing business with JP Morgan Chase. So they have fixed income trading, bonds, currencies, commodities. Guess what? That revenue was up 21%. Market volatility drove huge client demands for JP Morgan expertise. So they go there and say, tell us, what can we do? Merger advisory fees rose about 28%, the highest dollar amount of any bank this quarter. The total loans grew from 11% to $1.5 trillion, and the bank capital reserve ratio is sitting at 14.3%, far above legal requirements. It can absorb major losses and still keep lending. So that is pretty good sign, because I know with all the private credit and all that, people were starting to get really bit worried about that. Now, all is not good with JP Morgan Chase. JP Morgan lowered its forecast for the net interest income, the profit from charging more on loans than it pays on deposits, from $104 billion to $103 billion for the entire year. That is $1.5 billion downgrade, and it is spooking investors enough to push the stock down despite the overall beat. CEO Jamie Dimon cited geopolitical tensions, trade uncertainty, and high government debt globally as a serious risk ahead. But if you know JP, what's his name? Jamie Dimon, he's always on cautious side. He's always pushing his people to kind of be on cautious side. So I don't really take those things as seriously as I used to. I wouldn't be spooked by them. So JP Morgan, $50.5 billion quarterly revenue is the biggest of any bank in the world. So I have to give that to them. Its 23% return on tangible common equity leads all US peers, so that number looks really good. Bank of America is sitting at 16%, Wells Fargo is about 14%, and Citigroup is at 13%. So in short, JP Morgan makes the most money and uses its capital most efficiently. The only real knock is its guidance. See, what is he thinking about this interest income? And I don't blame them, obviously, with considering where the interest rates are going, it becomes very difficult for banks to really price their products. So that is what's happening with JP Morgan Chase. Next one, which is one of my another favorite company, is Citibank. Let's talk about that. So obviously Citibank is a global bank, not just United States. They operate in 160 countries, and currently they are midway through a major internal restructuring to simplify the business and improve profitability. So that is going very well for them. This quarter was their best quarterly revenue in the last 10 years. So that's a good news for them. Stock trading jumped 39% for them, and bond trading rose 13%. Citi's large global trading operations was perfectly positioned for a volatile market like what we just saw. Actually, we've been saying ever since President Trump took office. Its services division, which helps corporations move money internationally, grew about 17%. Winning 40% more new clients mandates than usual. So that is going to continue to fuel growth for Citibank as well. Now, hear this out. Citi bought back $6.3 billion of its own stock, a major signal for financial confidence. So they do think their stock is still undervalued. So Citi, well, just like anybody else, not everything is handy dandy. So Citi fees from advising on merger and helping company raise money through stock sales came in below estimates. So they're not really doing as good of a job there. The bank operates in so many many countries that any global conflict or trade restriction hit it harder than domestic focused peers. Citi's profitability is about 13.1% return on equity, is still well below JP Morgan Chase, which is at 23%, and Bank of America, which is at 16%. Closing that gap is the 2 to 3 years story investors are waiting and watching. So that is why the stock is also growing, because they do think Citi will be able to do that. Citi had the biggest percentage improvement in profit this quarter, 42% versus last year. So that's a good number, but still trails peers in overall profitability. The good news is it is the cheapest of the large banks, trading at roughly 18 times earnings versus JP Morgan Chase is at 13x after adjusting for growth. So there's more upside if the turnaround continues. Citi's global footprint is a double-edged sword, so keep an eye out for that. It opened doors others can't access, but it certainly adds more risk as well. Then the next one is Wells Fargo Bank. Wells Fargo Bank, if you don't know, is the fourth largest bank, mainly serves U.S. consumers and businesses, currently operating under Federal Reserve growth restriction imposed after a 2016 fake account scandal. I'm so surprised that these banks can survive after such a big scandal. But anyhow, here we are. So their trading revenue surged about 38%, showing Wells Fargo is successfully building out Wall Street style business it previously lacked. So they're trying to compete with some of the other players like JP Morgan Chase, Morgan Stanley, as well as Charles Schwab and all that. The total loans grew about 10% and deposits by 6%, both solid, can't complain there. Wealth management client business also grew about 11% to $2.2 trillion. Profit per share grew about 15% year over year. The bank returned $4 billion to shareholders through strong buybacks. I keep seeing that again and again in these companies. Wells Fargo is the only large U.S. bank still operating under Federal Reserve imposed assets cap of roughly $1.95 trillion. It literally cannot grow its total balance sheet until regulators lift it. This structurally limits how much Wells Fargo can lend and earn. The loan interest profit, net interest income, missed estimates because interest rate cuts have squeezed the gap between what bank earns on loans and pays on deposit. But that applies to every other company that I talk about. The efficiency ratio of 67% means 67 cents of every dollar earned goes to operating costs. Compare that to Bank of America, which is more efficient and at 61%. So what can we make out of Wells Fargo? Well, Wells is the weakest of big four banks right now, largely because of Fed assist cap constraint that peers don't face. Once that cap is lifted, expected maybe in next 6 to 12 months, Wells has significantly pent-up growth potential. Until then, investors sees it as show-me story. Bank of America is the most direct comparison. Bank of America is sitting at 60%, 61% efficiency ratio versus Wells Fargo Bank is at 67%, shows how much operational drag Wells Fargo still has. So if you're a risk taker, then Wells Fargo could be your company because they have a huge potential once that cap is listed. Next one up on list, Bank of America. Bank of America, America's largest, well, not the largest, that's JP Morgan Chase, second largest bank. Strong in consumer banking, wealth management through Merrill Lynch, and growing in trading and corporate lending. They actually did fairly well as well. Every single business segment grew year over year, a rare achievement for a bank of this size. The loan interest profit grew 9%, driven by fixed rate mortgages and loans repricing upward. Merger advisory fees rose about 21%. Sales and trading revenue climbed to 13%. The consumer banking division is the number one in the US by deposits. Operating efficiency ratio of 61% is a class leading among large banks. So they're doing really good running their business. Now, Bank of America earns more of its money from loan interest rather than trading and deal fees like some of the other banks we talk about. For example, Goldman Sachs and JP Morgan Chase, they get a lot of revenue from all this trading. This makes Bank of America more sensitive to interest rate changes. If rates fall further, that steady stream of interest income gets squeezed. The bank set aside $1.3 billion as a provision for credit losses. So be careful, watch out for that. Money is reserved in case borrowers cannot repay the loans. So banks are already preparing for that, which, while down from last year, shows caution about economic environment. So Bank of America is the all-weather bank of the group, not as exciting as Goldman in deal making, not as massive as JP Morgan Chase, but consistently solid. Its loan interest income story is the cleanest among Big Four. The Merrill Lynch Wealth Management platform, sitting at $2 trillion in client asset, gives Bank of America a recurring revenue stream that insulates it from when markets get choppy. So I wouldn't be super excited, but I wouldn't be super bearish on it. Another company we should also talk about is BlackRock. So you guys all know BlackRock has made a lot of headlines recently. So I think it's important that we talk about that as well in this segment. So BlackRock iShares ETFs products attracted a record $132 billion in new money this quarter alone. Investors fleeing volatile markets poured money into passive index funds because they get scared. They don't know how to manage the money. They're timing the market constantly. So this is a problem, by the way. This is the reason why ETFs do so well. Most people can really figure out which company to invest in. It's not that crazy. I mean, we talk about this on our free WhatsApp group all the time. Where are the opportunities? I think those are easy to spot. That's not what the problem is. The problem is your ability to hold when that stock drops 30, 40, 50%. Most people give up. They sell out. They think they made a mistake. And then what do? They move to the index fund. So then they are not able to take that upside. I mean, think about it. If the stock dropped 30, 40, 50%, this is when your risk is the lowest. This is the time to buy, not when the stocks are high, but most people sell out when the stocks are down. Anyhow, BlackRock knows it. They take benefit out of this and they say, hey, you don't have to worry about it. We're going to take care of that. So like I said, $132 billion in new money this quarter alone. Technology subscription revenue from Aladdin, the risk management software used by a lot of institutions out there, grew 22%. Dividend raised 10% and $450 million. And guess what? In stock buybacks, again, stock buybacks. Total clients revenue also grew to 139 trillion. In 12 months, organic fees growth was 10%. Now, total assets under management, AUM, what we call, actually dipped slightly despite the record inflows. Market value decline offset the new money. Institution index strategy investor withdrew $34.7 billion. Insiders sold about $124 million of stock with zero purchases. So I will be very, very careful touching the BlackRock right now. A private credit fund BlackRock runs had to limit clients' withdrawals amid heavy redemption requests, raising question about liquidity in private market. And I talked about it, made another video, so you can go watch more about that because it does impact everything that we do. Now, BlackRock 44.5% operating margin is far ahead of State Street, which also beat estimates but operates at roughly half that margin. Vanguard, private, no earnings. Fidelity, also private, are the closest scale competitors in ETFs, but BlackRock Aladdin technology platform used to manage risk for pension funds, for central banks, and sovereign wealth funds create a business rival cannot easily replicate. Switching away from Aladdin would take years, and that's why BlackRock is able to bring these products to the market. So this is what we have in earnings. There are other companies as well. Like on my notes, for example, I have Johnson & Johnson. We have Fastenal that also reported. TSMC also reported, Pepsi, and then obviously Coca-Cola will report. So I'll make a separate video on that. But before I end this video, let's talk about Charles Schwab, because how can we miss Charles Schwab, right? They are the America's largest retail brokerage where ordinary people like you and me open investment accounts to buy stocks, bonds, and funds. Also provides banking and wealth management through its advisory network, manages $11.8 trillion in client assets. So it's one of those biggest companies out there. They had a record revenue and earnings driven by, once again, market volatility. Remember, whenever there's a lot of market volatility, guess what? These banks are making money. Simple as that. By the way, this is the kind of stuff that you want to learn. And this is what we talk about in the coaching program. Like, how can we spot these trends? So when we expect markets to be so choppy, usually these bank stocks end up doing really well as long as we don't run into recession or interest rate problems. So we kind of have to kind of look into those. So Charles Schwab, record revenue and earnings driven by market volatility. When markets are volatile, more people trade, which means more commissions and service revenue for Charles Schwab. A record 9.9 daily average trade means clients were extremely active. New client money, net new assets total $140 billion in just one quarter. Operating profit margin hit 51.4%, meaning Schwab kept 51 cents as profit for every dollar earned. A crypto trading platform and pre-IPO share access are new products expanding the business as well. TD Ameritrade integration is now fully complete, so that is helping with their profitability as well. Now, some things to remember about Charles Schwab. Schwab had a rough 23-24 after the Silicon Valley Bank crisis. Rising interest rates caused clients to move cash from low-yield Schwab accounts to higher-yield alternatives like money market funds, cutting Schwab's lending income. The company took on expensive debt to cover it. That hangover is fading, but still slightly visible in loan interest profit figures. Revenue slightly missed, according to the analyst out there. The record trading activity is partly driven by extraordinary market volatility that you cannot count on. Markets tends to cool down. They are volatile and then they cool down. So I'll be very careful with that. Schwab, $11.77 trillion in client assets dwarfs Interactive Brokers, which is at $568 billion. By the way, we got to talk about Interactive Broker maybe some other day, at least when their earnings come out. And that makes it closer peer to like Morgan Stanley, Wealth Management, which is at 6.9 trillion. And then I think Fidelity is the most direct competitor, but doesn't really report public earnings, so that we cannot really cover that. The Schwab edge, compared to some of these other companies out there, is low cost retail access and the scale they have. $35 million accounts versus Interactive Brokers serves more active traders and generates more revenue per account to margin lending. Another company we can also talk about is BNY, because I think they also reported last week as well. I think a couple of days ago. So the world's largest custody bank is BNY Mellon. Maybe some of you guys don't know that bank, but it doesn't lend much money to consumers. That's why you don't really hear about it. Instead, it safeguards and administers $59.4 trillion in assets for pension funds, sovereign wealth funds, and institutional investors worldwide. Think of it like a vault keeper for global finance. So you might not have heard of it, but now you know. I think the stock ticker is BK. So they also had a great quarter. For every 13% increase in revenue, expenses grew by only 5%. Meaning BNY generated 8 cents of new profit for every dollar of additional revenue, return on tangible equity of 29.3% versus, compare that to JP Morgan Chase and some of the other banks, it's pretty good. The assets held in safeguarding is also hit all-time high, I think $59.4 trillion. Loan interest profit grew 18% because BNY is reinvesting maturing bonds at higher current interest rates. They also won a major U.S. Treasury contract to run Trump accounts alongside Robinhood for brokerage. So new $10 billion stock buyback program was also authorized. So I think that also shows you a lot of confidence in this bank as well. Some of the exceptional performance was driven by market volatility. So we already know that. So when global institutions are scrambling, BNY earns more from currency exchanges and settlement fees. When market stabilizes, some of that elevated revenue will normalize. Expenses are growing, and management guided them towards the top of their 3 to 4% full year range. The 42% profit jump, while real, partly reflects a weak comparison quarter a year ago. So if we compare BNY versus State Street? Well, both are custody banks. BNY is about 29.3% return on tangible equity versus State Street mid-teens is significant equity quality gap. Northern Trust is another smaller custody bank and wealth management player. BNY ultimately moat is moving $59 trillion in assets to a competitor would require years of work and approvals. The switching costs are so high that clients almost never leave. So that makes BNY is still a strong player in this category. So it kind of gives you an idea as to what's happening in the banking world. But overall, if you look at it, strong earnings out there. So this is the first sign of confidence that markets are going to be just fine this year. So thank you so much, guys, for spending your last 15, 20 minutes with me. I'll try my best to bring more earnings, more insights to you over the coming days and weeks. Now that tax season is over, I have more time to talk about this stuff, and I'll be more active on WhatsApp group, and I'll be doing more meetups to meet with you guys in person. Thank you so much, and I'll see you next time.